Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
Warren Buffett, the CEO of Berkshire Hathaway, is renowned as the most accomplished stock market investor globally. As the stock market faces a 20% drop, record high inflation, and increasing interest rates, we can turn to his past interviews for timeless guidance to help us navigate this challenging period. Buffett's investment approach is centered on value investing, which entails choosing stocks whose market price is lower than their intrinsic or book value. This suggests that the market is currently undervaluing the stock and that it has the potential to increase in the future. Warren Buffett warns against making the mistake of buying a stock solely based on the anticipation of its price going up. As per Buffett, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. Make sure to subscribe to our channel and hit the notification bell before starting the video to receive timely updates.
The fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. I mean, we're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they have that feeling that they just feel better when stocks are going up.
Buffett clarified that their investing triumph lies in making long-term investments in businesses that possess enduring favorable economic attributes, which they call the secret sauce. This method is commonly referred to as value investing, which prioritizes holding onto high-performing stocks rather than actively trading based on short-term price fluctuations. Buffett is recognized as a buy-and-hold investor who does not intend to sell stocks in the short run to generate capital gains. Instead, he selects stocks that he thinks have promising prospects for long-term growth. This leads him to diverge from others' actions and focus on whether a company has a stable position to generate revenue in the future and whether its stock is priced reasonably. Take a moment to listen to these two clips.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Among Warren Buffett's numerous investment principles, one of the most crucial is emphasizing self-investment. He highlights that becoming smarter and more knowledgeable can aid in becoming a better investor. Additionally, he thinks that investing in oneself encompasses having sound financial habits such as refraining from overspending, avoiding credit card debt, saving money, and reinvesting profits. Buffett believes that the most effective safeguard against inflation is being exceptional at what you do, delivering a remarkable product or service that is in high demand and providing something that people are willing to pay for. In particular, he stated that your own earning power is the best defense against inflation. Your talent cannot be taken away from you, and that if you offer something of value and benefit society, the value of the US dollar becomes irrelevant. Buffett was asked about inflation predictions, to which he responded that attempting to forecast future inflation is a futile exercise. He emphasized that despite anyone's claims, the reality is that no one can accurately determine the level of inflation in the next 10 years, 12 months, or even 4 weeks. Buffett stated that inflation deceives almost everyone, indicating that inflation can have detrimental effects on individuals and businesses.
Keynes said it many years ago that it's an invisible tax that only one man in a million really understands. The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, the value of the dollar since I was born has declined by 94% to 6 cents. But things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.
According to Buffett, the key factor in selecting a lucrative business investment is the company's competitive edge, which he compares to a moat encompassing an economic castle. He has emphasized that a strong competitive advantage, like a deep and wide moat, offers protection against competitors and secures the company's position in the market. Buffett regards a competitive edge as a crucial determinant of long-term success in investing. Warren Buffett believes that the stronger the competitive advantage, the greater the chances of a company's success over the long term. He contends that it is more advantageous to purchase an exceptional company at a reasonable price rather than an ordinary company at an excellent price. Buffett has stated that investing in high-quality companies with strong competitive advantages, even at a higher cost, will likely lead to more significant returns in the future.
When you go into a drugstore, 7-Eleven or something, and you say, I would like a Snickers bar, and the owner says, oh, I've got something, the Musk bar, at 10 cents off the Snickers bar, you say, give me the Snickers. And if he doesn't give you the Snickers, you go across the street and buy the Snickers. It's probably easier to develop a new car than to compete with Snickers. But some products have terrific moats. Probably Elmer's glue does, WD-40. People that have an iPhone, they want to continue with the product that they've got. They want the new version. It's just easier for them. They learn how to do everything, and their life's built around it and all of that. And moats are very useful. Costco has a moat in people's mind. I mean, Amazon can raise the price of Prime, 20%, and you can't do that unless you've built something within that image of the Amazon Prime that's based on reality that you're going to get a lot for your money and you're going to want to use it. And then you can raise prices $20. But if you're selling, some commodity product, you can't do that. You need a moat. In 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
Buffett's investment philosophy embodies his practical, down-to-earth Nebraska mentality about life. His approach necessitates patience, a focus on the long term, and purchasing stocks when they are undervalued. As Buffett put it regarding prudent planning for the future, someone is sitting in the shade today because someone planted a tree a long time ago. This quote encapsulates Buffett's belief in the significance of foresight, delayed gratification, and making sound investments early on to reap the benefits later. Our discussion for today has come to an end. We value your thoughts and encourage you to share them in the comments section below. If you found this video informative or entertaining, please show your support by giving it a thumbs up. Make sure to subscribe to our channel to stay up to date with the latest videos and news. Thank you for watching, and we look forward to seeing you again soon.